I'm Greg Hunter. Welcome to USAWatchdog.com. First, before I bring on my next guest, I have to say I thought for sure with 20 some odd states taking on the Texas lawsuit and, the Supreme Court justices, all three of them put in there by Trump, which they all ignored him on this case, didn't want to take it. All the other attorney generals on the other side, a huge case. I mean, a massive, never seen before case. And the attorney general, we'll kick it out. That said, I'm not bound down to a false god and a false winner of an election. That's Biden. I mean, come on, everybody knows what happened. I mean, it's just all these statistical anomalies all went negative against Donald Trump. Oh, so there weren't statistical anomalies. It was willful. It's just you just don't have neurons touching together if you think this was an honest election, really. I mean, or you're 100% corrupt. It's unbelievable. But there are multiple cases that are filed in multiple states. I don't know if the Supreme Court will take any of them or roll them all into one or whatever. Who knows? There's still a chance for Donald Trump to win. There's still a chance for either one to be president. I hate to even say that, but there is so. But here's what I wanted to bring on our next guest. It doesn't make any difference who's president. What's going on in the economy is dreadful, and no matter who is elected, and I think it's going to be Trump. Ultimately, I do think it's going to be him. But no matter who is elected, the economy has some serious problems, and one of the biggest problems surrounds all the debt, unemployment. Another 853,000 people filed for unemployment. And to talk about what's coming in 2021 for the economy, the cold hard facts, I have Rick Ackerman of rickackerman.com, famous for Rick's picks and his hidden pivot points. He's an analyst, he's a trader, he's an all-around good guy. Rick Ackerman, thank you for joining us today on USAWatchdog.com.
Always a great pleasure to connect with your large audience, Greg. Glad to be on.
Well, one of the things you said in the pre-interview was, listen, the debt, you can't get around the debt. The debt and, all this unemployment. I mean, 853,000 people filed for unemployment last week, right? 853,000. And those are people who aren't paying their bills. I mean, they don't have any money to pay their bills, unfortunately, and that's not any bad or ding on them. Let's start with the debt that you talked about. What's coming in 20? What's your overview of what's coming? Oh, stop before I even start. A couple of years ago, I just want to tell the story of my audience. We were all. Everybody was worried about the 10-year Treasury shooting up past 3%. It was 2 something, whatever. And all these people on this side, oh, it's going to go up. It's going to, gun lock, and all these other people. Oh, if it hits 3%, we'll all be killed, and all this stuff. And you came on and said, it's going down. It's going down. Dang, if you weren't right, it did go down. So just to let you know, you've written for Barron's and other magazines, and you're a real guy. And anyway, back to just a little bit more on your resume, a little bit more on your predictive, your analytic powers. The debt. Let's start there.
I've been kind of saying the same thing for a long time, Greg. And if you put it into investment terms, if you're long the bonds from the late 70s for the next 35 years, you did just fine. Early in the 1990s, we had an attempt to kind of gun our way out of the savings and loan crisis with a lot of stimulus. And the Fed governors were out there doing their thing, saying, we may have to tighten. And I was pretty much every week saying, tighten my butt. You're not going to tighten anything. The Fed doesn't really have it in it to tighten. At least they haven't since Volcker. So we keep needing more and more stimulus, really, to create just a nominal amount of growth. And I want to mention that Lacey Hunt with Hoisington had a really interesting number out there. This is something I wrote about for Barron's a couple decades ago, and it had to do with the productivity of debt. How much borrowing does it take to create $1 worth of growth? And at the time that I wrote it, I thought, we're never going to get out of this. We just owe too much, and just servicing the debt's going to crush the economy. But in retrospect, there was a failure of the imagination. I had no idea just how pumped up we were going to get, and also how minuscule these $400, $500, $600, $700 million figures were tossed around about how big the problem was. But that was really just tiddlywinks compared to what we've got now. So the specific figure from Lacey Hunt is that it's taking a dollar's worth of borrowing creates about 27 cents of GDP growth. And if you sort of take that and flip it around, you see that it takes $3.40 of borrowing just to create that dollar's worth of growth. That trend is obviously unsustainable, and it's not like we've hit some sort of peak and we're going to back out of it and everything will be fine. It just means that whatever we talk about in the way of stimulus, whether it's a 1 billion or 2 billion or $3 billion package or whatever, the stimulus is having less and less of an effect. And because it has less of an effect, it stimulates the stimulators into doing even more stimulating, which essentially means more borrowing. So that's what's called a debt trap, and we're very much in it. And you can talk about stimulating the economy, and no question you get a shot in the arm on the consumer spending side, and also with asset inflation and housing and the real estate market and the stock market. But don't kid yourself that you're creating sustainable growth that will be sufficient to pay off what you're borrowing to supposedly stimulate that growth. So we're not going to grow our way out of this.
You're thinking that we're going to have some big defaults. Let's talk about the big defaults in commercial real estate, residential real estate, restaurants, pension funds. You're saying there's no way around the defaults.
Well, I think we're sort of at the level of tulip bulb mania, where the insanity was so great that people would trade things that had the value of a whole house just for a rare tulip bulb. I think we're really at that level when we price out Airbnb right now for about $100 billion. And the DoorDash meal delivery thing, I think their valuation is something absurd too. And of course, they're not making money. So things are really very crazed, and it sets up a condition where, we're talking about stimulating the economy back to health, but what we see stimulated is really stock values. And of course, people think, well, the stock market's going crazy, I guess things can't be all that bad, but they really are. And when you try to extrapolate a happy picture from the fact that we've got $100 billion tied up in Airbnb, you miss the bigger picture. There is the job losses, which you were talking about, and they don't even begin to describe the problems out there in the job world, because one of the biggest components of what we take for good news on the jobs front is that the perverse fact that so many people are stopping, that they're not even looking for jobs anymore. So you've got a huge drop-off factor that's making unemployment seem much lower than it really is. And of course, when you talk about the ripple effect of those 800,000 restaurant workers, let's call them, or people working stiffs, they all buy things, they pay their landlords, and there's a stream of money there that eventually trickles up to people who, the rentiers, maybe you could call them, who haven't been quite as affected, but they will be. The more, I think it's something like 70% of the economy is based on, it comes out of small business. And even though we have these huge businesses that we sometimes see as kind of dominating the economic landscape, the fact is that collectively it's the little guys who they don't dominate it in the discussion really, but in purely economic terms they do. So there's a lot of pain to be felt, and it's not just in the money flow, it's in the collateral structure that's given us, for one, a derivatives market that, depending, if you want to be really conservative, you could say it's a quadrillion dollars plus, but I think you could estimate it up to 2 trillion. Well, every dime of that is really just borrowed money that has some form of collateral behind it. And for instance, you might have bonds that have been hawked 20 times over, that come from the stream of revenues generated by the New York transit system. transit system is dying. They're dying everywhere. And it represents a giant hit to capital. We've got all this capital tied up in things that are not anywhere near their intended level of productivity, efficiency, their ability to service debt. So that we haven't even begun to reckon with that. We're saying, hey, Airbnb is great, and we don't even think about writing off the New York City transit system, or for that matter, the transit systems in all the cities. And another even bigger, if you can imagine bigger, a bigger write-off than that will be these office towers that are never going to come back into use the way they were. That they're going to be underutilized, and that goes beyond just simply not having a lot of seats filled in an office. It means that the office itself is, from an economic standpoint, is becoming obsolete. The bonds that finance the construction of these office towers, they can't be serviced either. So again, another huge hit to capital, and so all these things, and even
You saying, when you say huge hit to capital, you saying default, bankruptcy, poofs, people taking losses.
eventually, yes, the bonds that financed all these things are going to have to get marked down. And one other area, if you can add something else huge to this list, is the energy patch. When we came out of the 2007 2008 financial collapse, the collapse occurred mainly because of the weakness in the mortgage markets. The fact that very, very, they lumped bonds, good housing bonds, with bad ones, and thought that will sort of take care of the failure problem. So everything was priced at AAA. Well, after that experience, it's not that anybody would ever learn a lesson. The question was, what can we hawk up to our eyeballs this time to get the system, to get the game going again? And a very big bet was placed on the energy patch. This is something, when you really want to get the game to sort of mount into the trillions of dollars, you need something real, like houses, and in this case, energy in the ground, oil, natural gas. And so there was an enormous bet, really. There's a huge expansion of, in part, the derivatives market based on instruments that had as their chief source of collateral energy resources. So you can imagine, we've been, the whole world sort of, certainly Wall Street cheers when oil prices go higher. We used to think, oh God, it's going to be $5 a gallon gas. But at this point, from a Wall Street point of view, we need $60 oil just to keep these companies going and to keep them solvent. But it's not working. And amazingly, the fix was in the oil patch as well, and we've had an increase in the value of a barrel of oil from $32 to around 48, and it's all taken place without without an increase at all in demand. It's supply driven, and the idea that you can push oil into the 60s by restricting supply gives you an idea of how idiotic the whole enterprise is, shoddy enterprise is. So oil collateral is very the illusion that somehow we can sustain high values for energy resources that are the collateral for enormous amounts of debt is the illusion can't really be sustained. If do we have recessions yet? We're going to have one. And so we got a lot of problems there on the debt side. And here we are looking at unemployment figures and the valuations given these absurd new IPOs.
Do you think we're just going to have giant collapsing values of real estate, of oil companies, of debt? Is that what you're predicting in 2021? A giant collapse?
Yeah, it all goes together. And to say 2021, I have to be upfront about the fact that I've been expecting this collapse for a long time. And again, it was really a failure of the imagination to imagine just how much things could get pumped and how delusional people could be that somehow we've got prosperity and the economy's going great. It's not. It's taking enormous stimulus, and we're getting less and less bang for the buck for the borrowing that's implicitly done when we do fiscal stimulus or monetary stimulus. So as far as 2021, I don't know. I think that that the election could precipitate out as a bear market, and that's irrespective of whether Trump winds up getting back in office or Biden wins. In either case, I think you better sell the news. Maybe start doing that even now. So I have real trouble believing that we're going to be able to sustain the illusion that things are going to be okay for a whole another year. So in that respect, I guess, yeah, I think 2021 is going to do it. And because the stock market is the psychological underpinnings of all the craziness, all of the extreme folly, um, everything's going to come tumbling down if a bear market happens.
And you think that these so office? I mean, there was something like some number like 90% of the office. This is about a month ago, and I don't think it's gotten any better with in New York City because they're shutting down restaurants and arresting people. That 90% of the office space is not being used. 90%.
Yeah, and you wonder really what when the bondholders look at it and think, well, we're going to see we're going to return to normal. They can't possibly be imagining the hustle bustle of New York City as of last February, let's say. It's not going to happen. So even if their idea of normal, you say 90% of the offices are not being used. If we could get that down to 70 or 60 or 50 or 40 or 30, even 30%, in other words, we're 70% of normal. That's not going to do it. That's not it's not going to do it even for the ground level amenities like the subway system and all the restaurants and Broadway and all that. So we just haven't reckoned with that. We're so focused on jobs as though it matters. And yes, it does matter if you're unemployed, but it's not the biggest piece of it. It's really just kind of the piece of it that's going to slowly feed into the next down cycle, which I think will, it'll be different from the 30s because we didn't have the infrastructure of affluence. We've achieved in material terms amazing prosperity. We've got great equipment to do stuff. Everybody takes exotic vacations, and I've often sort of characterized the Second Great Depression as a situation. You're going to see people riding to the soup kitchens on $8,000, all graphite trail bikes.
I had great minds think alike, and one of the things that I had Bill Holter on a while back, actually with Jim Sinclair, Bright Guys, and Holter blurted out, "Listen, the losses in the commercial real estate market are there. You just haven't seen them yet." Do you agree with that?
That's absolutely true, and you can see it in the obvious places where all the shopping malls are going under, and when we didn't have any other things to worry about, and we worried about that, we thought, well, somehow the REITs that built a lot of these shopping centers, they were coping, and they were kind of winnowing things down and slowly transforming shopping malls into multi-purpose, where you had offices, small commercial, some residential. But you can only do so much of that. I mean, there's so many malls that are headed into failure, and even we're not even halfway there with the anchor tenants. We've got still left to fail. We've got Macy's, we've got Nordstrom's, a bunch of others.
Sears, Pennies.
Yeah. So, well, right. Sears was kind of the long goodbye there. It took them 50 years to go out of business.
Yeah.
So yeah, I think that we really we're not even reckoning with the hit to commercial real estate. It's just happening. And it was hard enough to cope with before the pandemic, with the REITs sort of shuffling things around and trying to, essentially mark down the property so that people could come in there and operate on at a lower cost. But there's just too much. There's such a glut of property right now, such a glut of space, and you see it locally on Main Street as well. It's not just the malls, and That has to do with the tax base that supports city services and amenities. We haven't played that forward in New York, for one, other than in the abstract. Well, I think, yeah, tax revenues in New York are way off, and you're sort of in a downward spiral there. I don't see a way out for New York, even though apparently it hasn't slowed down the billionaire penthouse category.
I'm going to get you to describe something for me because I want to bring it down to street level. And that is, you say we have this illusion. I believe you. I see teachers driving, and they got a $40,000 job. They're driving an $80,000 car. What are the payments? It's ridiculous. But anyway, you say that we have this illusion, and the illusion's going to stop. Describe to us what it's going to look like when there is no more illusion. What is it going to look like?
Well, I think probably besides a bear market, the most obvious trigger to sort of alter our thinking and anchor us, or at least bring us in the direction of reality, is the pension system. There's no, you're not going out on a limb when you predict that Illinois' pension system will probably be the first state pension to go bankrupt. And at that point, we're going to have very clear evidence that the Fed could never really do much. I mean, they can stimulate asset inflation, but they really can't put the economy back on a good track. And each recession cycle has sort of put us deeper in the hole. The debt is just incredible. All right, so Illinois' pension goes under, and we have this idea, you always say, well, the government will step in. But I always suggest when you hear the word government in a context like that, you substitute the word taxpayer. So, yeah, if Illinois goes down, the taxpayers will bail them out. And that sort of brings you closer to the reality of it. So when there are probably about 25 to 30 states in not so great shape. They would follow Illinois into bankruptcy. And of course, you see the slippery slope there, because if there's any bailing out of Illinois, California, New York, Connecticut, New Jersey, a whole bunch of others are just going to get in line and say, hey, how about us? Another fact about why you can't monetize a collapsing pension system, in this, we have this phony asset inflation that sort of tides things over. But with the pension collapse, it's not an asset value you're inflating. You're actually printing checks to send out to pension beneficiaries.
They're sucking off a debt ball.
Right. So here all of a sudden you're sending out checks to 130,000 state of Illinois retirees every month, and you can see that how long can that last, especially with other states in similar dire straits. So it can't. And if you sort of take it in the direction of, well, it'll just have to print whatever it takes to indemnify, to meet these pension obligations, then you really are on the slope to hyperinflation. And when you get there, that of course is self-defeating, because you get your $2,000 pension check and you discover that it won't buy a cart full of groceries. So the pension system is really, I think, where we're going to come foursquare up against reality. And it's going to happen, I think, pretty obviously in conjunction with the stock market collapse. And really, I don't want to, again, put myself in that situation where I just fail to imagine how absurd things can get. But I just have this feeling that $100 billion valuation for Airbnb is up in that neighborhood of it. This is just about it's 2 outs, ninth inning.
But do you think that we're going to achieve tent cities? Do you think we're going to have violence, insurrection, massive crime? I mean, give us a picture of street level. What is it? When 850,000 this last week, I think we're headed back to the million individuals filing for unemployment very soon. I think it's going to be in the millions very soon. Because that's the trajectory it's back on, with all the lockdowns and Newsom, and they're trying to kick him out, and De Blasio and old person killing Cuomo, who murdered a bunch of people. That's what they say, murdered a bunch of people in nursing homes with his stupid putting COVID patients in these nursing homes. It's thousands, they say. But anyway, are we going to have tent cities? Are we going to have food lines? Are we going to have people that, might take 10 years to get a job, a recovery? Explain what it looks like.
Oh, a lot more than 10 years. I think structurally we've destroyed so many jobs that are never coming back. Um, uh, you know, I used to think in the simplest way to make the argument, what are we going to have? Is it going to be a zombie apocalypse, or what's coming when the economy goes under? And I used the example of someone riding to the soup kitchen on an $8,000, all campy hardware graphite trail bike. But there were two sides that I used to look at. One, both friends of mine. One, Sean Broderick, had a book out called the Urban Survival. It was the Urban Survivalist Guide, I think it was. And he said, we're not going to flee for the hills with water rations and ammo. Essentially, we're going to hunker down in our suburban cul-de-sacs, and we're going to just be very neighborly and try to get each other through it. At the opposite extreme, I talked to one guy who had essentially gone off the grid to live in a commune, a self-sufficient commune, and place in Western Pennsylvania that he would not identify. And he said, suburban cul-de-sac, are you kidding? The Army Ranger in our group says that you need at least 2 sniper positions to even defend a cul-de-sac. So that kind of represents the spread of where we might be going. And I think, unfortunately, we may be headed more toward the latter than the suburban cul-de-sac. Everybody sort of pulls their load. And the reason I say that is because we're close to a breakdown in social and civil order to begin with. We're practically in a shooting war here over politics, and I don't know. You don't really have to buy the idea that the globalists want to take over the world to think that we're in a very bad state of in a very bad condition right now to have the kind of cooperation that we're going to need that got America through the Depression of the 30s. So it's really unpredictable, but we have a wickedly volatile and toxic political mix right now that would be a part of any severe economic downturn.
So we had relative peace in the Great Depression, where people, okay, we all know it's bad, let's pull together. You're saying we don't have that now.
No, and even in economic terms, there's some very key differences. In the 1930s, maybe about a third of the American population, the adult working population, literally lived off the land. They were connected to the agricultural economy. This time, job descriptions are so arcane, we don't really know. It's hard even to imagine how some people fit into the economy, like what they're actually producing that makes us all better off. So we've gotten so kind of subspecialized in the job world and what people do that we're going to find out really how many of those jobs were completely unnecessary, like 95% of the people who work for government. So we're that's coming really. And another difference between the 30s is and now, we had a sound dollar, and that helped. People weren't as deeply in hock. They weren't in hock to mortgage lenders, for one, or automobile lenders. And I think to a very significant extent in the 30s, people were generally more self-sufficient. They could do things, they could fix things, and we are no longer self-reliant in that way. So I don't really know what's going to get us through it. And I hate to think that the only thing that's going to get through it is the severity of what we're about to experience.
Wow, that's a very nice, and I'm not making fun of you at all. Please don't think that, but it's a very nice and cerebral way to say the crap's going to hit the blades, and it's not going to be like the 30s. It's not going to be like the Great Depression. Where you get a few people like Bonnie and Clyde and stuff like that, but you might have thousands of Bonnie and Clydes in one group.
Yeah, we won't even have Shirley Temple.
Yeah, I'm just going to bring this up. I had somebody write me. And I'm not making fun of them. I'm not going to say who they are, but they talked about having a gold IRA, and I don't believe in that. Not with what you just described. I don't believe in a gold IRA. I don't believe in paper future contracts unless you're some Uber trader. I don't believe in. I don't tell anybody to trade, and I don't sell anything. I do have some traders on because they're smart, and I want to because they have to be smart, otherwise they'd be broke. But somebody wanted to tell me about an IRA. I said, listen, gold is not a tax strategy. Okay, this is a core asset survival strategy. I think I told him the right thing, and he wrote me back and said, thank you for telling me that, and I agree with you because what's coming, all the rules are going to get broken. That's what I told him. All the rules are going to get broken. Do you agree with that? Gold is not a tax strategy. It is a core asset survival strategy. Don't worry about it going to 20,000 or whatever it is that, it may only go up to, 2,000, but there may be nothing else left. Right?
Yeah. Yeah. I've never been in the gold at 50,000 an ounce or even 5,000 an ounce camp. And for those who are, I say, look, you better be really a fast talker if you're going to shove a handful of your Krugerrands to balloons in the hands of some farmer and try to buy farmland for that handful of gold, or for that matter, buy a loaf of bread. So it's hard to say what gold is going to bring in barter.
But better to have it than not, though. But you still believe in it, though.
I absolutely do. I think gold will, without thinking about it, it's going to go to 50,000 an ounce. It will definitely retain its purchasing power.
Yeah. And silver.
But I think we're going to have a sorting it out period where, if the banks, if we have a banking holiday unscheduled, and we have to sort out a new money system, I always tell my subscribers to keep a shoebox full of money around, because initially that's going to be the only thing that vendors understand. The ones, fives, tens, and 20s worth nothing really. They're a form of debt, not money. But ironically, paradoxically, they're going to be money initially. And I think silver will find its way into a system of barter. So I would definitely be keeping gold. But it really disturbs me that some of the frenzy in Bitcoin is in Bitcoin in preference to gold. That seems really crazy to me. I'm just not buying that Bitcoin is money. When I look at a chart of Bitcoin, I love it. I just want to be in it, and I want to go with this. The rally in Bitcoin has been the most powerful rally of any asset, if you can call it an asset, since March. I mean, it's outperforming everything, very noticeably gold. But I'm not a big believer in that. I think that Bitcoin, the blockchain, cryptocurrency idea is great. I mean, it's a good way to secure transactions, good way to secure a whole bunch of things. But I don't see it as money. I just see it as essentially a speculative mania.
Not a core asset, not a survival asset.
Yeah, and I think to have this idea that in the worst of times, when God forbid the government is even more in control of things than they are now, that they're going to somehow let Bitcoin sit there apart from a centralized money system. That's, you guys can have your money and we'll have ours. It's not going to happen. Yeah. And that at that point, the blockchain encryption that makes Bitcoin so secure will become essentially the ledger there for the IRS or whoever to see exactly what your financials look like. So I don't think there's no hiding your whatever wealth you're able to preserve in these difficult times that lie ahead. The idea of hiding it in Bitcoin, I think you're very vulnerable in that way. And anybody who wants to trade Bitcoin for gold, just I think they're crazy.
Well, even Bull Pony, who puts out trading strategy, people made a lot of money trading it. Okay, but he says at some point you're going to have to trade out of that. I mean, he said kind of the same thing you did. It's a trade, and a lot of people don't realize that if you're trading, you got to take profit at some point, right?
Yeah.
You got to trade out of it at some point. When is that point? And I don't know.
Well, if that point is triggered by some extraneous shock that everybody realizes is bad for Bitcoin, who knows what the exit doors will look like? We've seen Bitcoin sort of go up and down in a very violently speculative way, but that was just sort of bulls and bears. It wasn't sort of every bull experiencing in the same epiphany some horrible piece of news, something that essentially either discredits Bitcoin or it renders it uh, much less valuable.
A friend of mine who's a lot better off than me he called me and says, you know what, what's funny? I said, what's that? He says, you go into a store, you buy some gold coins. I said, okay. And he says, how much? It's going to be X. Okay, so I pay him 5,000 or 6,000 or whatever it is for how many 3 coins. And he says, and I hand him the money, and I know the guy, so he knows my check is good or whatever. I said, okay. And he says, and at the end of that, he said, yeah. And I said, yeah, that's it. No taxpayer ID, no social security number, no. Isn't that amazing? You could spend $5, $10, $100,000. Thank you very much, Mr. Smith. Have a nice day. Here are your coins. He says, that's amazing, isn't it? I said, yes, it is. He said, it's better than Bitcoin, isn't it? I mean, it's invisible. I guess he's right. I guess that's what you're saying, right? In a way that you can hold gold or silver as a core asset.
Yeah, and it's always going to work. It's always
Yeah.
come hell or high water, inflation, deflation, hyperinflation. It's going to retain its purchasing power relative to anything else you could be holding. So, why not? But I think gold would do just fine.
And if you were going to sum up 2021, and I'm not asking for a dead solid prediction, but you think we at least get the beginnings of some really nasty debt destruction, write-offs, defaults. Is that a good? Would you summarize what you think 2021's going to be in the debt world?
Well, I think that if we get through 2021 without an incident, it'll be a miracle, which is as much as saying it's coming. Sooner or later there has to be a time of reckoning, a day of reckoning. And again, I'll just tell you, I've been so wrong for not wrong really. I think it's just a failure of the imagination to see how long the con could go on. But as I said, I think these valuations that are being put on these IPOs right now, when we're headed into a recovery that is going to be very limited in nature and is ultimately unknowable, to be making these huge bets in IPOs, it tells you just how desperate money is for a return, and all the huge corporate cash surplus, their cash hoard, $2 trillion. It's nothing. It doesn't even exist really, because they've all borrowed that much. There's a pure debt offset. So all I can say is that I think we're so primed really in 2021 to have that day of reckoning, and it wouldn't be unusual or illogical for it to occur when we sort of realize the best of all worlds. We've been hoping for a very effective vaccine, and it seems like there are a couple good ones out there, although, unproven. I understand that one of the vaccines is attracting a little notice, that the possibility that it might leave women sterile, and a couple other minor details. But so I think the markets have gotten so far ahead of anybody's best hopes for a vaccine. But also on the political side, if you say Wall Street has already demonstrated it can live with Biden, I say that's absolute rubbish. Biden represents the most anti-business thinking that we've ever had in American politics and leadership. And I think that even if Trump is reinstalled, that it's going to be it'll be a time to sell the news. So the catalyst for the collapse will be, here's the news. It's everything that we were hoping for has happened, and where do we go from there? And at that point, we're going to have to reckon very quickly with the fact that all of this borrowing that supposedly was going to stimulate us out of the hole is borrowing that has to be repaid in one way or another, and that one way or another is a very it's not rocket science really. We talked a little bit about this before. C.V. Myers had a book out in 1976 called The Coming Deflation. Obviously, he was a little bit ahead of his time, but not. If you'd sort of taken him literally as an investor and been in bonds from 1980 till the next 35 years, you would have done great because the well out the year yield curve is very leveraged to short-term changes in short-term rates. So you could have been getting 25% gains in capital gains in bonds over many of those years. So it's been a great strategy. And but Myers kind of boiled it down to just one sentence, and that is ultimately every penny of every debt must be paid, if not by the borrower, then by the lender. So when we talk about letting the students skip and go naked, $1.6 trillion in debt, student loans, it's so delusional, this because the bondholders are going to pay or the taxpayers are going to pay, and we don't really escape debt. There's bonds that are pegged to the stream of payments that would come from these students. So to talk about the government forgiving, it's not the government, it's the taxpayers, and we'll all take the hit. So, and in the same way, I can't make mortgage payments. I'm going to walk away from the house and cancel out the debt. The debt hasn't been canceled. The lender gets stuck with it. So that's been happening for a long, long time. We're sort of we paid for the debt in a way, I wouldn't say it's invisible, but we paid for it in our standard of living. When you look at the enormous things that have been lost since the 1950s, supposedly the standard of living has improved so much, but in many of its key components, it has gotten worse. We had a situation in the 50s or 60s, a single breadwinner could afford a household, afford a couple kids, put them through college without hawking the house. And, we had doctors making house calls. We could afford medical care then. Women could tend to the business of the household and raising of children. And so we paid an enormous cost, really. A lot of it comes from the necessity of double income, or these days you need a triple or quadruple family income just to pay the bills. And I'm talking about even at the level of professionals. He's an accountant, she's a lawyer, and they borrowed money too. So the standard of living has really declined as we borrowed more and more, and we've got a lot of fabulous gizmos to sort of distract us from the fact that we've lost so many of the big things, the things that count for something when you talk about a standard of living. It's not all about 55-inch TV screens and things like that.
Would you say, last question, would you say 2021 is going to be the year of the debt collapse?
I hesitate to say it's going to be this year because I've been thinking it would be this year for so long. But I would say we're in a very, very heightened state of risk right now because of the political instability, by the fact that the news media have gone AWOL. They've gone completely derelict. People have drawn lines and taken sides, and I think we're in a very unstable position. And at the purely, at the financial end of it, we've got the stimulus that is not really stimulating anymore in a meaningful way. It's just a shot in the arm, and it's certainly not stimulating an economy that's healthy enough to pay back the debt. And we put ourselves in a position where we can't afford to have interest rates ratchet even 30 or 40 or 50 basis points higher. We can't. I mean, the consequences are too dire to imagine, and yet it's going to happen. When if the dollar continues to slip, which it will, because we're in stimulus mode, money printing mode, it's going to force interest rates up, regardless of what the Fed wants to do. And the thing that we fear the most, like there's no way that the $250 billion derivatives market and all that we owe can survive a turn of the screw, being subjected to even slightly higher rates. So when we're in a situation where it can't happen, it's as much as saying it absolutely will happen.
At some point, forget the year, at some point, we're going to have a debt collapse.
Yeah, but I think we're so close, really, and I know it's just sort of flimsy anecdotal, but this $100 billion valuation for Airbnb, it reflects a level of sickness, of insanity, a mass psychosis that to me puts us very close to the mother of all tops.
Yeah. Airbnb, they don't have any assets. They just have an app. They use everybody else's assets. I get what you're saying. Rick Ackerman of rickackerman.com. You also have a community of people there that you can be a subscriber to. Tell me about your subscription. You offer a dollar deal for 2 weeks for your subscription service. That's what, 40, $50 a month.
Hard to beat. Hard to beat. Yeah, if you go to rickackerman.com, up in the right-hand corner, there's a start trial. For $1, you get 2 weeks. That includes the daily trades that I put out that kind of track the market, give you a pretty accurate sense of where things are, where they might be going. I'm technically glued to the market because I know, you can be wrong with your opinions, but I've got a great chat room, draws traders from all over the world, a very helpful bunch. They share good trading ideas in real time, very high-minded discussion. So you get, for just $1, 2 weeks, you can try it out and see if it works.
Also, there's free articles and free writing. You're a fairly prolific writer. Free articles on rickackerman.com as well, just if you don't want to, join it all too, which is, you're very cerebral. You're a smart guy. You put out a lot of good stuff. Rick Ackerman, thanks for joining us today on usawatchdog.com.
Thank you, Greg, for inviting me on.